Right now, across the United States, millions of Americans are quietly running out of money. Not all at once, not in a dramatic collapse, but slowly, silently, week by week, bill by bill. And by the time most people fully realize what's happening, it may already be too late. At first, everything looks normal, paychecks arrive, bills get paid, life moves forward, but beneath that surface, something is shifting, something far more dangerous than a single recession or market dip. And however, this is not the kind of crisis that makes loud headlines right away. This is pressure building in real time, inside households, inside bank accounts, inside everyday decisions. Every swipe of a card, every trip to the grocery store, every refill at the gas station. It all adds up, and the real problem is, it's adding up faster than income can keep pace. The cost of living has been rising steadily, almost invisibly at first, housing costs creeping higher, insurance premiums increasing, healthcare becoming more expensive, groceries refusing to come back down, and then, something changed. What happened next changed everything. The gap between income and expenses didn't just widen. It accelerated. People who once had a small cushion began to lose it. Savings accounts started shrinking. Emergency funds disappeared. And for millions of Americans, credit cards became the bridge between survival and collapse. But here's the shocking part: that bridge comes with a cost. Interest. High, compounding, relentless interest that turns small deficits into long-term financial traps. $100 here, $200 there. It doesn't feel like much in the moment, but over the next 30 days, over the next few billing cycles, over the next year, it becomes something much bigger. And this is where it gets serious. Because once households begin relying on credit to fund basic living expenses, the system becomes unstable. Minimum payments rise. Interest accumulates. Financial flexibility disappears. Suddenly, one unexpected expense, a car repair, a medical emergency, a delayed paycheck, can push everything over the edge. That's how modern financial collapse happens, not through one catastrophic event, but through accumulation, through pressure that never fully releases. Dollar by dollar, week by week, quietly. However, the story doesn't end at the household level. This is not just a personal finance issue. It's a systemic shift. Consumer spending drives a massive portion of the economy, and when millions of Americans begin pulling back at the same time, the effects ripple outward. Restaurants see fewer customers. Retail stores experience slower sales. Travel demand weakens. Small businesses feel the strain almost immediately. What begins as individual financial stress quickly transforms into a broader economic slowdown. And this is where the financial warning becomes impossible to ignore. Because as spending declines, businesses react. Hiring slows. Expansion plans pause. Investment becomes cautious. And what started as a cost of living problem begins to evolve into a market shock. The economy doesn't collapse overnight. It tightens gradually, then suddenly. Employers notice declining morale. Productivity shifts. Workers feel the pressure both at home and at work. The national mood begins to change. Anxiety rises. Confidence drops. And once confidence begins to crack, the situation becomes far more dangerous. Because economies are not just driven by numbers, they are driven by belief. Belief that tomorrow will be manageable, belief that income will cover expenses, belief that stability still exists. But here's the shocking part: once that belief fades, behavior changes instantly. People stop spending. They delay purchases. They cancel plans. They hold on to every dollar. And when millions of Americans make those same decisions at the same time, the slowdown accelerates. Businesses feel it. Markets react. Forecasts are revised. And the cycle begins feeding itself. This could change everything. However, to understand why this is happening now, you have to look deeper. For years, the cost of living has been quietly outpacing income growth. Wages increased, but not enough. Meanwhile, essential expenses kept climbing. Housing became less affordable. Healthcare costs surged. Insurance premiums rose. Education expenses remained high. Food prices increased. And most importantly, these costs didn't go back down. They stayed elevated. So when additional pressure hit, whether through fuel costs, inflation spikes, or higher borrowing rates, there was no buffer left. For many Americans, the margin between stability and financial distress became dangerously thin. And this is where it gets serious, because once that margin disappears, even small disruptions can have massive consequences. A missed paycheck, a reduced work schedule, an unexpected bill. These are not rare events. They are common realities, and for households already stretched to their limits, they can be devastating. The real problem is the system many people rely on was built on the assumption of stability, steady income, manageable costs, predictable expenses. But in 2026, that stability is no longer guaranteed. Volatility has become the new normal. Prices fluctuate, costs remain high, opportunities feel uncertain, and millions of Americans are navigating this landscape without a safety net. But here's where the story takes another turn. What happened next changed everything. Perception began to shift. Media coverage intensified. Analysts started issuing warnings. Social media amplified financial anxiety. Conversations changed from optimism to concern. And when perception changes, behavior follows. People begin preparing for the worst, even if it hasn't fully arrived yet. Spending slows further. Businesses become more cautious. Hiring freezes begin appearing. The economy starts responding not just to reality, but to expectation. And this is where things can escalate quickly. Because if enough people believe they are running out of money, they start acting like it's already true. That collective behavior can transform a slow financial squeeze into a full-scale economic downturn. The next 30 days, the next few months, could determine whether this remains a period of financial pressure or becomes something far more serious. If costs stabilize and incomes recover, the system may hold. But if pressure continues, if expenses keep rising while incomes struggle to catch up, the ripple effects could spread deeper into every part of the economy. Housing markets could slow. Consumer demand could weaken further. Labor markets could tighten. Investment could decline. And suddenly, the conversation shifts from financial stress to financial crisis. However, history shows that these moments, while difficult, often become turning points. People adapt. Spending habits change. Financial priorities shift. Businesses innovate. Policies adjust. The question is not whether change will happen. It's whether it will happen before the breaking point is reached. Because once millions of Americans feel broke, the consequences extend far beyond individual households. It affects how people spend, how they save, how they vote, how they plan for the future. It reshapes the entire economic landscape. This is not just about money. It's about stability, security, and the ability to plan ahead with confidence. And right now, that confidence is being tested like never before. So the next time you check your bank balance or feel the pressure of rising costs, remember, you are not alone in this experience. This is a larger shift unfolding across the country, a financial warning that something deeper is happening beneath the surface. And if current trends continue, 2026 may be remembered as the moment when millions of Americans reached a tipping point, when the slow squeeze became impossible to ignore, when everything began to change. Stay with us, because in the next part we break down exactly what you can do, what signals to watch, and why this could change everything. Because understanding what's happening now may be the difference between staying ahead or falling behind.